Today we'll talk about four basic option strategies. So first is buying a call. So when you are buying a call, your outlook is bullish and the risk is limited to the premium that you paid. And there is an unlimited profit potential as stock rises. So typically you buy when the volatility is low and you have to identify a clear area of support and make sure you have at least 90 days to expiration, mainly because the theta decay or time is your enemy here. That's why you got to give yourself plenty of time. Let's illustrate this with a simple chart here. We have a stock here currently trading at $40. Since you're buying a call option, you have to look at a clear area of support. So typically around, say, right here at 30 in this scenario. And what you can also do is really look at the chart, look at the area of support, and you can also see the delta. Typically, we tend to sell around delta 70 or lower, so or higher, so that way, you are in the money or deep in the money. And make sure as you're selling this option, make sure the volatility at this point is low. So that's typically buying a call option. And buying a call option is somewhat, it's a bullish strategy. And, we can also cover along the same lines writing a put. Because writing a put is also a bullish strategy. Your outlook is bullish and the risk is limited to, risk is unlimited, meaning as stock price goes down, your risk will increase. And your maximum reward is really the premium that you received to write a put or to sell a put. This is also called short put. There's one more terminology. And to reduce the risk, you could combine this with another position. For example, you could sell a um, vertical spread instead of a simple put. And you have to make sure the volatility is high when you sell a put option, and you have to identify a clear area of support so that way it does not go below that support, and make sure you got at least 45 days to expiration. And the theta decay is your friend. As the time elapses, you'll kind of keep incurring your profit. So now we'll talk about the buying a put. Buying a put is a bearish strategy. Your outlook is bearish here, and the risk is limited to premium that you paid. Generally, when you think stock is going to go down due to some reason, that could be a good time to buy some put option, and the maximum profit will accelerate as the stock declines below the strike price and reaches zero. And typically you buy a put option when the volatility is low, and you have to identify a clear area of resistance and at least 90 days to expiration, because time decay is your enemy here. You got to make sure you got plenty of time. And writing a call is also somewhat similar in the sense it's a bearish, you have a bearish outlook. And writing a call is also called selling a call or a short call. And maximum reward is limited to the premium that you received. And the risk is potentially unlimited as the stock price raises. So as the stock price raises, you will, above the strike price, you'll start accumulating losses. And this can be combined with other position. For example, you might have a stock already and you're writing a call, or you might want to buy a sell a call vertical. Those could be used to limit your risk. And sell a call option when the volatility is high, so that way you receive more premium. And identify a clear area of resistance above the stock price, so that way you will make money as stock falls below the resistance. And make sure you have at least 45 days to expiration. So we give less time here because time is your friend here. So as time decays, you will start incurring more and more profit. So as you see here, current stock price is at 40. We kind of sell a call or a short call at 50, which is above the current stock price. And as time elapses, you'll kind of keep retaining more and more premium. So these are the four basic option strategies, and all other strategies will basically leverage these four strategies and build on that. So with this, let's go to thinkorswim platform and illustrate these four strategies. Let me go here. I'm in thinkorswim platform. Um, let's first look at Tesla for our bullish strategy. So as you can see, let me go back to Tesla chart here, and also quickly let me go to a previous date here, 8/12. So we are in August 12. Tesla chart. Let's make it 10 o'clock Eastern time. But in the meantime, yeah, let's get the chart here. So if you look at this chart as the buffering is going on, we are right here. We are on August 12, as you can see, and volatility right now is kind of coming down a little bit after the earnings, as you can see here, and also it's bullish. As you can see, the DI plus is shooting up, DI minus is going down, and volume on the balance volume is positive, and there is also good chocolate money flow, meaning money is flowing into the stock. This could be a good time to really start opening a bullish or buy a call option. As we discussed earlier, we would at least do 90 days in the future, give us enough time for this to make some profit. And also we talked about at least delta 70. Let's go to delta 70 here, which is right here. I will go ahead and sell, actually um, buy this call option at $329. So let's go ahead and confirm it. So total price is $32,000 in this scenario. And let's go ahead and send. Done. So for our next position, we will sell some put options, which is again a bullish strategy. So for selling the put option, like we discussed earlier, we want to give us plenty of time. So we'll choose a time frame when volatility is a little bit high. So for that, I would go here. If you see here, volatility is high, which is 318. I would initiate around 318 time frame. For this illustration, let's go 318. In the meantime, let's quickly go here to monitor tab, look at our Tesla position that we just bought. This is the one. Expiration is November 20 November. All right, so for our next position for Tesla, we'll go to 318, which is March 18th. All right, so we chose March 18 because volatility is really high at the time, so that's why we chose March 18 to sell a put option. Let's wait for the chart. All right, give it a minute, it's almost there. Okay, so as you can see here, volatility is shot up here, and stock seems to be bullish because as you can see here on the on balance volume is going up. I mean it's kind of trending down, which is okay, and the DI plus is shooting up, and also if you look at chocolate money flow, it's kind of going a little bit down. That's fine because volatility is high. It's a good time to initiate a put position. Let's go here. Like we discussed earlier, we would at least do something along 45 days to expiration when you sell put option. So currently stock is at 396. We would really do delta 20 or so below the stock price. So let's go to delta 20. In this case, I think delta 30 is the minimum here. Let's go to delta 30, Stock is at 398. We are actually selling a 350 put. For that, we are collecting $55. All right, so we did that. So now let's do one thing just to see how we are doing in our two strategies from a profit perspective. This is where we sold May, 1st May. So let's look at how we are doing from a profit perspective on the expiration date. Let's go to 1st May here. And as it's buffering, let's look at the chart very quickly. So we sold our put option, on 318. So somewhere near March 18, when the volatility was low, when the volatility was high, that's when you sell your options, put options. And right now, as you can see here, volatility is getting lower, which is I think it's a good time to take some profit, being expiration day. And as you can see here, stock is also increasing from a volume perspective. On the balance, volume is going up, and from a Chaplin money flow perspective, money is flowing into the stock right now, which is telling us stock is becoming a little more bullish. So that's a good time to take some profit because we sold a put option and still buffering. Let's look at our put here. I think it's not completely done buffering. In the meantime, let's spend a little more time on the chart to see Tesla. Um, as you see here, volatility is also kind of rising as we speak. Um, So volatility is actually in the process of coming down, as you can see, which is a good sign for us. We sold when the volatility is high. Now it's coming down, and the strength RSI is going up, which is good because we sold our put option. It's good for the stock to be bullish to help our position. So I think all the stars are aligned. As soon as we are done buffering, we can go back and just take some profit on this one. And in the meantime, from a stock selection perspective, we chose Tesla here because Tesla is known, very volatile stock. It, as you can see here, you could easily look at this volatility chart and identify areas when the volatility is high. That could be a good time to sell these put options. And when the volatility is low, for example, these points here and even here, those could be good time for you to buy some long put options or even long call options or call spreads. And one thing you can notice is really as the volatility is going down here, stock is getting stronger, money is flowing into the stock, volume is going up, and volatility raises, as you can see here, chatting money flow is going out of the stock, and volatility, the RSI, in this case RSI is also going down, which is a little bit bearish type sign in this case. So you can try to look at a couple of key indicators like implied volatility, RSI, on the balance volume, and even Chaplin money flow to really see where will the stock go? Will it go bullish or will it become bearish? So based on those couple of key indicators, you can try to take an educated guess and take it from there. All right, with that, let's go back to monitor. Still buffering. Thinkorswim is pretty slow today. Looks like. Let's go to Tesla here. I think it's still buffering. Let's give it one more minute. Okay, we are done buffering. So let's go to Tesla put position that we sold. It's expiring today. I think we made a good profit here. As you can see, we made 5,900, almost $6,000 profit. Let's go ahead and take the profit here. All right, so next one is our call option here. Call option is expiring on November 20th. Let's fast forward to November 20th. All right, so as it's buffering, let's quickly look at the chart here on November 20th. So we sold our stock somewhere around 8/12, August 12 or so, somewhere here, I guess, August 12. When the volatility is low, and now we are here, November 20th. Looks like stock is going up, and volatility is kind of, it's not too high, it's somewhere in between. So this should help our position that our purchase of option here. Let's see how that's doing. In the meantime, as you can see here, money is flowing into the stock, which is chatting money flow is showing that stock is getting bullish here. There is also some rumors around this time that even Tesla might get added to S&P 500 index. DMI clearly shows DI plus, which is the blue line, going higher, and DI minus, the red line, is going down. ADX, which is a momentum indicator, is going up, which is a bullish sign for Tesla stock. And really, if you can predict the direction of the stock, it's a very good time to initiate some positions. As you can see at 8/12, this is when we kind of predicted it might go up and bought some call options. And at this time, we made the decision based on volatility and things like chattel money flow, on the balance volume, and even the DMI at the time was positive. So we looked at a couple of indicators to initiate a long call option. Um, and as you can see, your volume also around this time, even volume is kind of going up, which is a good sign. And one more thing to note is around 8/12 or so, Tesla was done with earnings, as you can see here. So it's a good sign. There was also some positive news around Tesla split, as you can see here, 5-to-1 split took into effect on 8/31. So with that, let's go to our Tesla long call that we bought right here. Okay, it's still buffering. Let's give it a minute. In the meantime, let's do one thing. In the meantime, let's look at the other strategies that we talked about, which is selling a call. If I go back here very quickly, we looked at two strategies. Which one is buying a call and writing a put. Now let's look at buying a put and writing a call. Both are very strategies. Let's initiate two positions for this as we wait for our Tesla to buffer. So for this, let's choose a stock which you all know, famous work from home stock, which is Zoom. So let's select Zoom here. For this illustration, I will choose 10/16, which is August 16th here. Sorry, October 16th. So October 16th, let's look at Zoom. It's coming up. So as you can see here, stock is kind of going higher, and the volatility is kind of low at this time, relatively low, and stock is kind of showing some Not so bullish, not so bearish type. It's again DI plus is up and DI minus is low. I would say it's a bullish indicator. At the same time, Chaplin money flow is kind of going down a little bit. There is a little bit divergence there. So what we'll do right now is we will basically buy a put, because we are thinking, hey, stock is at an all-time high, so maybe a good time to initiate a put position. So with that, let's go to trade tab, and for the put position, like we talked about, we would go around 45 days. 42 is good enough here, and stock is at 427 right now, still buffering. Let's give it a minute. So what we would typically do is we will go a little bit higher than the current stock price. So we'd go around, let's say 15 delta or 30 delta. Let's see when we get it. So actually 70 delta. Yeah, um, you know the platform is a little bit slow. In the meantime, let's go back here. We're talking about buying a put. We want to buy the put above the current strike price, and we want to make sure it's a level of resistance. So if the stock is at 40 in this scenario, we are buying a put option at 50, assuming stock will decline. With the let's go back here, still buffering. And as it is buffering, the writing a call is also same way. You here we bought a put at $50, and if you go to writing a call, now we are selling a call at $50. Both are bearish. Main difference is, when you're buying a put, you want the stock to fall all the way to zero, or as low as possible. You'll make maximum amount of money. Your profit is uncapped. Whereas here, writing a call or a short call, your profit is just limited to the premium that we initially received, but your downside is more. So that's the two main difference between buying a put and selling a call. With that, let's go back here. Um, Looks like it's still buffering, but you get the idea. So let's quickly close this. Um, so um, we talked about four key strategies: buying a call when your outlook is bullish, risk is limited to premium paid, maximum unlimited profit potential as the stock raises. Give yourself plenty of time. And buying a call and writing a put, both are bullish strategies. The main difference is writing a put, your profit is limited to the premium that you received, and you got unlimited risk. So unlimited reward in buying a call, unlimited risk in writing a put. So that's the main difference. But you'll receive the premium upfront here, and other two strategies are buying a put, again a bearish outlook, and your risk is limited to premium paid. You got unlimited profit potential, and the close relative of this is really selling a call or writing a call. You will get the money right away with your premium, but the risk is unlimited as stock rises. Hope this helps. Happy trading. Thank you.